it is getting to be time for PFICs, passive foreign investment companies. And I know many of my fellow CPAs who think that the government made these rules so complex just to make it unaffordable to own a foreign investment fund. And I understand it's really complex, but with complexity comes tax planning choices. So we're going to go over who has to file the form, some of the unique items. I'm sure all of you know the basics of it. And then we're going to look at just a few of the tax planning opportunities. So let's kind of start off with what's new. And of course, it's pretty hard to understand that. So they actually have nicely put it down below here of who must file. And so the U.S. person, that is a direct or indirect. And here, indirect is used in a different way than it does with controlled foreign corporations. And that is one of the challenges with international tax law. The same word is used differently in different aspects of it, and you'll always have to look up the definition. And we're going to get to that definition in a moment. So the person who receives a distribution, the person who recognized gain on a direct or indirect disposition of the PFIC. Want to look at two words here, receives and recognize. We'll get back to those in a second. Information with regards to a market-to-market election, is making an election and is filing the annual information for a market-to-market election. So those are the 5 cases where a U.S. person has to file the PFIC form. So we're going to get up to some of the other aspects here. I can change the screen and make it a little bit easier to fit into my window here. Okay, perfect. So let's get to indirect shareholder. So an indirect shareholder is a 50% or more shareholder. So you don't have to own all of the company. You can own half of it. And I can only imagine how this would cause complete chaos in trying to not pay tax on somebody else's profit. So this is a real great tax planning choice. Ken and I own stock of a British Virgin Island tax haven corporation, which then is invested in a bunch of PFICs. Ken kindly decides to make their market-to-market election when he files the Form 8621. I, on the other hand, I'm not going to make an election. I'm not going to file Form 8621. Why? Let's go back to the 5 reasons. I did not receive a distribution. I did not recognize gain. I am not making a market-to-market election. I am not making any election, and I'm not reporting a past market-to-market election. So Ken goes ahead and pays tax on money he hasn't received. Thank you, Ken. And now comes time a few years later, after Ken has done this, let's say for a decade, for the foreign corporation to make a distribution to me. We will see in a few moments as we look through this form instructions that there's an overlap rule. And our controlled foreign corporation, even though it owns PFIC stocks and it would fit the definition of a PFIC, is not a PFIC. And that law changed or came about in 1996. So what Ken has kindly done for me, he's paid tax on profit. It has reduced our earnings and profits inside the foreign corporation. And as we learn on the Form 5471 discussion, earnings and profits is the key to determine how much tax a shareholder has. So Ken has kindly paid tax on half of the profit for me, and I thank him very much. An indirect shareholder is a shareholder of a PFIC when it owns a PFIC, okay, a shareholder, okay, a shareholder of a domestic corporation which owns a PFIC. Once again, this is kind of a oddity because this event will never occur. Why? Back to the 5 people who have to file. A U.S. person, which is this domestic corporation, has to file if it receives the money, if it recognizes gain, if it makes the elections. So when my corporation, a C Corp or S Corp, has any of these 5 events, it's going to file. I am never going to receive a distribution from the PFIC because it's going into a domestic corporation. I will receive a distribution from a domestic corporation at some time in the future, maybe, but it won't be a PFIC. I would not recognize gain. I would not making the election. So just keep in mind that you can read this instruction, but you'll probably never have a case when it applies. We have some people who do not have to file. The most common one would be your retirement account, an IRA, your 401k plan, qualified annuity, of course your qualified tuition program, all the tax-exempt groups that one can form. And that's because there's no reason for it. These entities are not paying tax, and there's no reason for the IRS to get this additional form. Now we get to the little bit complicated area, pass-through entities. So this is where there's duplication and some thought really has to be given to all of this. A U.S. person that is an interest holder of a foreign pass-through entity that is a direct and indirect shareholder of a PFIC is going to have to file the form. So if you form a LLC in a foreign country or a corporation in a foreign country that can elect to be disregarded or partnership, it owns a passive foreign investment company, you're going to have to file a form. A U.S. person that owns a trust under the grantor trust rule, and this includes a foreign trust. Pretty tax neutral because we know that we pay tax, because we know the IRS sees all grantor trust as completely non-existing. A U.S. partnership, S corporation, or U.S. trust other than a grantor trust is a pass-through entity. So this is going to affect the beneficiary, and let's go back to how this comes about. So the beneficiary may have to file a Form 8621. They don't say what beneficiary. If you're a discretionary trust, a 10% owner of a trust, they leave it completely vague. Obviously, you want to have the trust file the form for the PFIC, and I really think that's where the reporting stops, because the trust is a separate taxpayer. It's making the election. So I think, once again, this is an instruction that I do not see applying in the world of the real world of taxation. Chain ownership, as you could expect, PFIC owns a PFIC. There's a lot of reporting. When to file, I think you all know that. And let's get down to the definition. Income test, 75% or more of the gross income of the corporation is passive income. Asset test, more than 1/2 of the assets of the corporation are the type that can produce passive income. So back to the example of a foreign corporation owning a PFIC, only PFICs, you think it would be a PFIC, but it's not. And that's called the overlap rule. And so when you have a foreign corporation that owns a PFIC, you have the Form 5471 reporting. You do not have this reporting. Now, what's nice is as we read through these instructions, we do see that with both the foreign trust and the controlled foreign corporation, the shareholder can make the election if he wants to make a market-to-market. And Of course, it doesn't work out when there's more than one shareholder, as I showed with my example with Ken owning the other parts of the corporation. But it can give you some tax planning opportunities. It gives you choices, and choices is what tax planning is about. And some of my experience when I've done the voluntary disclosures, and we go back 6 or 7 years, and the client has not filed his PFIC form, it turned out that not being a qualified PFIC was an advantage. And the reason was because the stock market was so volatile. So if you were qualified, you would have reported your capital gain, let's say through year 2007, reported maybe your Dow Jones going from $10,000 to $14,500, paid tax all the way up. And now the crash comes, and now you have a capital loss. Between the 2 years, you actually took a loss because the Dow went down below 10, but you pay tax. You pay tax on phantom profit. The advantage of the PFIC, a non-qualified PFIC, is all that profit is kept inside this this corporate shell. The disadvantage, of course, is not going to come out as long-term capital gain. So that is it for PFICs. We're going to have a few questions and answers, and